Welcome to the Private Equity Exchange 2007, the only summit bridging the gaps between limited partners, private equity funds, corporate executives, and entrepreneurs. The Private Equity Exchange is the only venue where LPs, private equity firms, corporate executives, and entrepreneurs meet, enabling them to move quickly from ideas to deal crafting. The Private Equity Exchange, the largest private equity event in Europe for CEOs, funds, and LPs. LBO for professionals. Managing P2P and listed equity from tough public to private to successful public to public.
I mean, the clear statement, the easy statement to make, if as a good starting point, is that public to privates are extremely challenging. I'd like to maybe orient this question towards Gilbert, maybe. Can you explain maybe why this is so hard?
I'm sorry, can you...
Why is it so hard to delist a company?
I mean, first of all, I like to say that situations are very different from one to another. I mean, when you look at a listed company, you first have to see how fragmented is the shareholding structure. That's the first point. Second point is what is your ability to offer a price at which you think you will obtain the threshold which are necessary to reach if you want to manage properly the company after the transaction. So it's to some extent it's hard because in the meantime you have to deal with financing which has a lot of constraints, and when you take all this, it's difficult to guarantee a success when you envisage a P2P. It's obvious, but needless to say that, for example, if you take the Rexel transaction that has been mentioned by Julien, you start with a block which is 73%. So the risk is very different from other situation of P2P where there is no significant shareholder and you have to convince the market as a whole, starting from a very low threshold. Second thing is that, and I think Olivier will come back on that, but it's not always easy to optimize, financially speaking, the debt package when you are with a listed target and free, and it's the least but not, the last but not the least is the way you can get comfort on due diligence and work alongside the management when you are with a listed company, because again the management is not really free to have the same dialogue with as the one we have on pure private equity, and the quality of information, even if there are some rules, is not always as deep as the one we get on private equity. So these are the main issues that we face in P2Ps.
How about the practical issues of actually reaching the necessary amount of shares to delist the company? Olivier, maybe?
Just to come back on what Gilbert just mentioned, because I think he's perfectly right. Reaching 95% when you actually buy a 73% block is very different from starting from scratch. A few years ago, you had a chance to make it to 95 when you purchased such a control block and paid a substantial premium. And we probably have one of the two, I would say, only examples of successful P2Ps in France, with Provimi done by Permira and Rexel done by Eurazeo. Nowadays, even if you actually buy a big block, I'm thinking of Séchilienne, for example, where the block was purchased by Apax from Air Liquide. It was not 73, it was 43, and a substantial premium, you don't get there. So P2P was very challenging, is now extremely challenging. That's point number one. From a practical point of view, reaching 95%, so people have considered lowering this threshold from 95% to 90%. EU directive allows you to go as low as 90%. There has been some resistance in France by minority shareholders activists saying, don't expropriate people at 90%. When we discussed all together before this panel, I think the conclusion we reached is, sure, it would be nice to have 90%, but we don't think it would actually change much, and that it would make a huge difference. In other words, you would still have the green mailers trying to secure a block and make sure you don't squeeze out, except in extremely large transactions where you would talk about 40 to 50 billion euros, where a 5% difference might actually exclude some green mailers from trying to block the transaction. It wouldn't necessarily be a big change for taking companies private. The other point is that I believe that the valuation of the stock markets have been such, and the sophistication of shareholders has increased substantially, so that today a number of shareholders know that in an LBO transaction, if they stay, they will receive a substantial flow of dividends, and therefore a number of them tend to stick and stay in the share capital of the company, and therefore, again, it has been all these issues that have made P2P more challenging.
Philippe, any commentaire?
Well, I think we agree. I mean, if I want to make an analogy on why you have so few P2P compared to other transactions, it's complexity. I mean, it's like a Lara Croft movie where you want something big to happen, but you need all the stars to be aligned at the same time, and you need the shareholders to want it. You need the management to be keen. You need the board of directors to support the process. You need to have, as Bruno Deschamps was saying, you need to have a reason to do it. I mean, if you don't have a value creation thesis, if you don't have a reason to delist a company to create value, there's no point. I mean, just delisting a company is not value creative. So, the only good news is you don't need Lara Croft. You just need many things which you don't control, and it's more complicated than a face-to-face deal. Now, the 95% issue is twofold. It's obviously the tax consolidation, but I think it's an impact on price, and it's potentially the ability to delist through a squeeze-out, which I think is going to be less and less frequent nowadays. Large difficulty is people like us tend to think in absolute terms when we do work to evaluate a company and evaluate a new business plan. We end up with a price per share which is fixed, and the market tend to think in relative terms. They want a premium, and depending on market conditions, we might or might not be able to give a substantial premium. And the funny thing, since many companies we looked at 6 months or a year ago, we offered decent premium, and some shareholders were laughing at us. And when you look at today's price, it's a fraction of the price we offered. And I think our view on the companies we're talking about has not changed.
Okay, so there are clearly some quite major obstacles when delisting a company. But one obvious way to prevent all these is to prepare very carefully. So let's talk through several aspects of this preparation work. The first to come to mind, obviously, due diligence. Olivier, could you talk us through some aspects of due diligence work for P2P?
Sure, very quickly. Due diligence is obviously something that is absolutely required to put together financing, so it's a must. Second obvious point is due diligence is an expensive exercise, and a number of private equity players are reluctant to go through this cost unless they have some kind of arrangement with a fee reimbursement or a breakup fee. This is a situation that we encounter very often, and that is difficult to resolve. Our experience is that it's usually easier to obtain such a breakup fee or fee reimbursement when you have a controlling or majority shareholder that will pay for that. There are some recent precedents, where the company itself will agree to reimburse the cost if a private equity fund goes through the exercise. Again, Apax on GFI Informatique recently. or others, like the business object tender offer, which is currently taking place, even though that doesn't have anything to do with private equity. So a must for financing, an expensive exercise, and usually feasible to obtain some kind of reimbursement, especially when you have controlling shareholders.
Any other comments on due diligence?
Gilbert comments on saying it's very different to do P2P when you have a controlling block or not is particularly true. But you have this myth about hostile takeover bid by financial sponsors, which remain to be seen. And one key factor not to forget is if you make an offer for a company, it has to be for 100%. So you need to have certain funds for 100% of the shares. And more importantly, when you have a change of control, most of the companies, if not all, have a change of control provision in their debt. So you need to have financing available to renew the existing debt, even if you don't want to leverage your transaction. And that what makes due diligence compulsory, because we've not yet gone into markets where banks are happy to commit to finance 100% of the required financing without looking into the accounts and looking into the company. And this is something very, very difficult to organize in the environment of a public company. Again, if you have a controlling shareholder, you can organize that through his board representation. But for a public company, it's roughly in the hands of the independent directors, and it's a very delicate mission to assume for an independent director, how to organize due diligence, to what level, who can access it. And Olivier can talk much better than I do of that, but the law provides, when you make offers, that information available to a bidder has to be available to other bidders, and in many circumstances it's very delicate because it means that competitors could access the same information. So I think it's in itself one of the reasons why we've not seen so many P2Ps, and it's a major deterrent.
And maybe there is another issue, which is because Philippe was mentioning the difficulty for banks to provide the financing without a proper set of due diligence reports. But from the sponsor side, this is very important to understand how and why we can pay more than the market. I mean, when you look at the P2P, you know that you have to offer a premium to be successful. So to which extent you can have your own business plan, which is different from the views than the research analysts may have on the same asset. And for doing this, you need, not only information, you need also a very good dialogue with management. And the issue is that when the management keeps saying that the prospects on the company are such, and you as a sponsor, because of your own work, own due diligence, you have a slightly different way to see the asset and to see the way you can develop the asset, then the issue is to convince the management to sustain a different business plan than the one which is available to the market. So it's a very sensitive issue, and usually we spend a lot of time to convince the management to support a different business plan than the one which is in the market.
Maybe just a last add-on on due diligence on the tax side. Of course, the banks will want to finance and will want to know how much debt can be pushed down. And, the easy way to push down debt is to distribute dividends. If you only have access to public information, such as annual reports, you'll only see consolidated set of accounts. And the consolidated accounts give no information whatsoever on the statutory accounts at each individual subsidiary level. So that makes the exercise extremely difficult unless you have the management playing the game with you and giving you information.
Okay, we're going to skip a point and go straight to the independent expert. There are some issues relating to this. Olivier, would you like to maybe explain these?
On the independent expert, obviously there is an inherent conflict of interest between the management of the company, with the management of the company, and therefore the stock exchange regulation imposes in such a case an independent expert to give its views on the fairness of the price offered. This expert, with the regulatory pressure, has been given more and more importance in the system, and the AMF has made sure that first of all he's really independent, and that he's paid properly, that he doesn't have a success fee because that would be a problem, etc. However, from a practical point of view, what we see is two things. One is this has been used by the AMF to basically, I would say, pass on the hot potato to independent experts and basically be more hands-off on kind of confirming the valuation and confirming the fairness of the valuation. The second, I think, that may be a personal conclusion, but I believe that a number of independent experts are still not equipped properly to do their own work. In other words, they can't actually go at the core of the projections to give their own views. So it's more an exercise to criticize or challenge the valuation of the presenting banks than a standalone exercise. And as long as this is the case, I believe that you may have criticism on the work of independent experts.
Have you found this, Gilbert, Philippe?
Yeah, I think when we're facing a very nice paradox now. I mean, it is true, and I'm back to my stars align when managements want to study a P2P. They face a big conflict. I mean, they have to be faithful to their shareholders and initially the market as a whole, and they are sponsoring or participating to a project which will make them at some stage being faithful to a new shareholder, a private equity firm or another group of shareholders, including the management. Okay, so this switch to one category to another is indeed a very delicate conflict of interest, and obviously, the information that is given to the market is given by the management. So, I mean, the IMF came with a new rule. I think it was last year or 18 months ago, which we could debate whether they pushed it away to third parties, but at least is trying to address this issue, which needs to be addressed. Now, the paradox I was referring to. Is we were saying that P2Ps, when you have a controlling block, is easier than when you are starting from nothing. This is a bit changing, bending the situation, because if you are to make an offer on a public company and it's comment on dit une offre non sollicitée? Unsolicited. No, but it's even a voluntary. It's offer? A voluntary offer. You put a price on the table, and it's a debate between the initiator and the market. The market might take it, might not take it, you find out. When you are buying a block, you are in a compulsory offer, and which means you have to bid at least the price you paid for the block. But when you end up having a third-party independent expert emitting an opinion on that price, it might be that the opinion of the expert is very different from the opinion of the seller of the block. So you could have bought a block at 100 and have an expert saying, oh, it's worth 200. And what I don't know, and it's interesting to see what my colleagues think, is if with these new rules, if you buy a block at 100 and the expert says 200, what the IMF will tell you? Do you have to pay 200?
Well, just a quick reaction on that. You're perfectly right in the sense that it is a paradox. Well, first of all, we have not come across an example where you pay 100 for a block and the expert says it's worth more. That's the good news. However, you're perfectly right in pointing out that the regulation, before it changed, basically said and assumed that if you actually negotiate a controlling block with a seller, you have a true negotiation, and therefore the price that comes out of it is a real price, and you don't have to ask yourself whether it's a good price or not a good price. The minority shareholders will benefit from the premium, period. Now, in the new regulation, it's bizarre because even if you actually do buy a controlling block, you will still have someone independent that will come and potentially challenge your price, which again to me is a bit weird, given the fact that you've had a negotiation between a willing seller of a controlling block, and then therefore with some power of negotiation, and a buyer. So I'm sure you can come across situations where you have a seller that really wants to get rid of its asset and sells it for a poor price, but this is in essence a paradox.
I think we are. I mean, this is another reason why P2Ps are very difficult, and I know of a few situations where nothing did happen, no offer was filed because of that point, and I think we have to be very careful about that in other circumstances. But we are now in a situation where compulsory offers could be at a known price. Okay. And I don't know how you get financing for that.
Well, moving on to another interesting, controversial talking point, remuneration of management. Now, and how this is calculated. Gilbert, perhaps would you like to take this on? Not much of a gift, I'm afraid.
Okay. I mean, look, it's a key tool of our transaction is to team up with management. I mean, in the way we share, I mean, risk and upside. And as you know, the management is really incentivized in our transactions, and which is true for pure private equity transaction, has to be true also for listed assets acquisitions. And here we touch another difficulty, which is how can you structure, an incentive, a management plan, knowing that you will have to disclose, most of it, and knowing that for not only for the employees but also for the public, it's something which is really reviewed with a lot of scrutiny. I mean, it's a constraint which is, I must confess, it's very difficult to deal with. The way you address it is to use tools that you all know, such as warrants, such as sweet equity, but you cannot be as flexible as you can be for pure private transaction. That's I don't know if Philippe has a different experience as sponsor, but we can structure a very attractive management plan, but knowing that you will have to disclose to a large extent, not all, but to a large extent, the reality of the package.
Yeah, and I completely agree. I think all the points we discussed before will lead us to do deals or investment in companies that will remain public, okay, for all the reasons we've named, and therefore this conflict between the management and the market is going to remain. So the issue of the management package is becoming a real issue. The private equity model is based, among other things, on the fact that we think it's good for managers to be incentivized as entrepreneurs, as owners of the company, and participating into the risk and as much as we can, very deep in the company. In the context of a public offering with a prospectus, that requires a lot of communication and transparency, and that's something, that's a fact, and we have to deal with it.
Another issue, I'm sorry for on this point, is that you are really in a contradiction, which is how can you convince the market that a certain price, the shareholders have to come to the offer, and in the meantime explain that the management is investing at such price as an acquirer alongside the sponsor. So it's very difficult to find a way to communicate on that. Okay. And especially if the management is already shareholder of the company, which has been the case in various situations. And I want just to mention one, which is Photostation. I think it's the example where a PtoP has failed because of a price which was badly perceived by the market, and the way the management was. Grand Vision, I'm sorry, Grand Vision.
Reality is, we in France, we haven't had these many problems with the management package issues compared to the States, where basically each time you would give managers some type of management packet, a shareholder would come along and say, the dollar you give for the management package is actually a dollar you give as a shareholder, and therefore I want the same price. And in reality, all these issues so far have been absent from the French debate, as well as transparency, by the way, because even though there is an increased pressure in terms of transparency by the EMF, when you look at offer prospectuses, you're still a long way from describing in details everything regarding management package. So they might be more surprises down the way on this crucial issue.
The final point about relating to preparation is the tax grouping and not being able to reach it if your take private fails. Sophie, can you talk to us about this a little bit?
Yes, well, obviously, any P2P transaction, when the tax advisor discloses the tax memo, we work on the assumption that we will not reach the 95% threshold. And therefore, the only way to have leverage and tax optimization is to, first of all, push as much debt down as possible, but knowing that you'll never have, for example, shareholder loans being at the level of the target. You'll only, at the best, manage to push the bank debt down, but not the shareholder loans. So what you end up with is a structure, if we can move a slide along. I don't know if someone... There. So you have the private equity house, which sets up a holdco, which is going to borrow the bank debt and have the equity from the fund, including shareholder loans. You buy the target, and I've taken an assumption, you reach 75%. So in France, you don't get tax consolidation because you need 95%. And so then, especially for foreign private equity houses, you can ask yourself the question, do we need a French vehicle, or can we just invest from offshore? The standard version is to set up a French holding company. But then if the exit strategy is another IPO, which can be typically one of the strategies, you can either sell to a strategic buyer or envisage a second IPO and exit. Then what you must know is that if the French holding company sells those shares before a delay of 2 years, then the taxation of the gains is 34%. So definitely don't want that. And if you want the maximum flexibility on the exit, you would want to contemplate, if you're a foreign PE, owning your investment through a Luxembourg entity, or, for example, where the delay of ownership is only 1 year as opposed to 2 years in France. But not setting up a French holding company can create other issues, and the main one will be trying to get a refund of all the VAT on what we call the transaction costs. An IPO, more than any other type of transaction, is a very expensive deal and attracts a lot of costs, so the deal fees, of course, of the fund and transaction costs. And if you bill them to a holding company which has no substance, so no managers located at the level of that holding company, which can then invoice management fees, then the VAT is a final cost. So at 19% in France, or I think it's somewhere in the area of 15% in Luxembourg, it's a high cost. So that, in fact, is the major reason or key driver for setting up a French company, to be able to pull out some key leaders out of the target and move them up into the holding company, make it an active company, and get a refund for the VAT costs. Now, if you only set up one holding company, as I'm sure most of you know, any debt that you cannot push down the structure, and so, for example, also shareholder loans and the transaction costs, which obviously stay at the level of the holding company, those expenses cannot be offset against the profits of the target. And most of the private equity houses ask us as tax advisors to view, what will happen in the future if ever, by a miracle, we do reach the 95% threshold, let's say over 2 or 3 years. How can we kind of keep those expenses nice and warm and available for the future? So to achieve that, if we can move to the next slide. Thanks. You would set up in France 2 acquisition holding companies. and create a tax group between those two SPVs. And the second holdco at the lower level would be the actually company making the offer and acquiring the 75% of the shares from the public. So all the debt and expenses and costs that have remained at the level of the holding company, because you have not managed to push those costs down in the structure, stay at the level of that, very small tax group that just gathers Holdco 1 and Holdco 2 in my example. And then if in 2 or 3 years the 95% threshold is reached, then the existing tax group will be enlarged and will be able to include all the French companies member of the target group. And any losses incurred up to that date will then be available to offset against the future profits of the target. So that's an interesting, flexible manner to structure the acquisition, if there is a hope in heaven that you'll reach the threshold, of course. Now, from a tax standpoint, when you do tricky structures or a bit too intelligent structures, you have to have a business reason. It mustn't be done only for tax reasons. And so the most obvious one to create 2 separate holding companies will be to achieve structural subordination. And so, for example, you could separate the mezzanine lenders would lend at one entity and the senior debt would be granted at another entity, or separate bank debt with the shareholder loans, or put the management company at the level of one company, not the other. Various business reasons can be found to justify 2 levels of companies. So that's my comment on the tax structuring.
I'd like maybe to add three points, which are a bit technical, but I think important when you consider P2P. One is following what my colleague just said about the structuring of the P2P transaction. As a matter of fact, the more you can have debt, at the corporate level, the better to optimize your structure, and the less sensitive you are vis-à-vis the tax integration. That's first thing. Second thing, there is always, a question that you have when you try to understand what is your probability of success in reaching more than 95% in a transaction. And you are, if I talk, for example, about Rexel, our decision was to say, look, we start with 73%. How much is the tax integration benefit? How much, and it's quite easy to calculate in your model. In Rexel, it was, let's say, between 1 and 2 euros per share. So the question after that is, how much should I pay in my price to try to convince, people that it is a good price for them to come to the offer? And we bet on Rexel. We bet on the fact that offering the best price, i.e., including the tax integration benefit in our price, was the best way to reach more than 95%. And by chance, it was the story, and it was a success. We were a bit concerned because during the offer, there is an institution which took more than 5%. So we thought we were under, quite difficult dialogue with them. But it was just, the collection of various funds within the same institution, and the institution told us very rapidly, look, don't worry, we will come at the offer at such price that we are not at above 5% just to try to get an additional price. So this point is important. You have to put value on the tax integration, and after that to decide how much you put into your price.
The concept, just to go on with that, the concept of paying an extra euro or price at 95%, depending on the gain you get from tax integration, has been thought about for the first time in Rexel, even though we didn't use it, as Gilbert said, but was actually put into practice in Page Jaune, in the Page Jaune deal by KKR. And interestingly enough, it didn't mean that people came or tendered more shares into the offer. So, even when you try to get the public into a reasoning where you say, okay, this is worth 10 euro, but if we reach 95%, I'll give you the extra euro that I gain from the tax integration, does not necessarily work, or at least experience has shown.
And of course, the situation depends on the actual target. If you have a P2P target which is very cross-border and where the EBIT is nicely spread across different countries, then it's much easier to do debt push down and put at least all the bank debt at the target's level, so you're only stuck with the shareholder and the transaction cost. So the adverse consequences is much lesser than if you do a purely French P2P where it's more difficult, and you there again rely on the expert on how much debt can you push down, and it's more complex.
And the last issue is your financing package. I mean, when you are considering a P2P without knowing what will be the threshold that you're going to reach at the end of the day, you have to deal with various documentations depending on whether you reach. 50% is a minimum for sure, but 66%, 95%, and the worst case being that you reach at the end of the day 94.9%, where you have let's say the weakest leverage, because at 94.9 you don't get the tax integration, but you have the maximum needs to finance. So and the way you deal with the documentation with banks, it's very difficult in these various scenarios.
Okay, let's have a quick look at what happens when you fail to delist a company, and what life is like for these listed companies under LBO. First, maybe looking at minority rights, Olivier?
Well, I think that there are two issues. One are the minority rights per se, and the other is the public scrutiny you have by simply having a number of shares out there. In terms of minority rights per se, depending on who the majority shareholder is, people get more or less comfortable with living with minority shareholders. Our experience is that once you get to 2/3 in a French company, you're essentially pretty safe and can do most of the things you want, with the sole exception of related party transactions. So if you have a great number of restructurings to do with another company, that can get in the way. But in most cases, when you, except in build-up cases, when a private equity fund actually makes a bid on a company and doesn't necessarily want to restructure it with another company of its own, it can do pretty much what it wants with 2/3. The second point is public scrutiny. I think public scrutiny is an issue in a P2P transaction, a failed P2P transaction, as we witness in a number of circumstances. Recently, maybe Gilbert will say a word later on, but the deal fees. We've seen that PAI got into a nasty fight with the CEO of Financière SPI recently, challenging the fees that were paid to the private equity fund. That obviously gets into the newspaper a lot more easily and is actually just public per se once you have a failed P2P. The second, I think, crucial point is debt push down. Even though the legal implications and pitfalls are the same, whether you are public or private, the scrutiny is simply a lot greater when you start pushing debt down in a public context. And this has not raised any real issue so far, but I think this will make a lot of headlines the day where you have a company with a big number of employees that actually hits the wall and files for bankruptcy, and when you've had a debt push down, I think people will get very excited, especially given the gap of perception and understanding there is between the professionals of the private equity world and the judges that will have to look at that, including the instruction judge. When we go and talk to magistrates in various circumstances, it's scaring to see that they are miles and miles away from what we see as standard practice done all the time, etc. So this public scrutiny, I think, is a real issue, not so much because of the minority rights per se, but because everything you do and you used to do in the private equity world is under a lot more scrutiny.
Philippe, any commentaire on this?
Yes. I think, this is obviously a real issue, but we should not lose the sight of the objective of P2P. Again, if a company is the objective of P2P, there's always a reason for it, which is meant to be value creative, and it should be always the case that the assumption is that the company is going to be managed differently if it's private or controlled by a private equity firm compared to being 100% public. Okay, so it should have an impact on the corporate governance, but more importantly, on the business plan and the risk taken in the business and the pace of change and the horizon. Very often, companies are followed by analysts or the markets as multiple of EBITDA or multiple of PE, and the management are constrained in their action related to that. They don't want to make such or such investment or such change in this business because it will impact their earnings per share, and they're worried about the share price going down, the consequences of that on their stock options, but on how the competitors will react, etc., and the cost of capital. So the idea of having a private investors who control the company is to give time to the companies to make difficult change, and that will may have impact on the first years in terms of positive cash flows or profits on earnings per share and things like that. So the most important thing when we do P2P is to be very, very clear when we talk to the market through the prospectuses and all communication on what we are intending to do with the company, and the fact that yes, it will have an impact on the next quarter's earnings. That you might not be so focused on the quarterly earnings anymore, but more on long-term investment and long-term value creation, which has nothing to do with immediate earnings. And yes, we are likely to take more risk for the business than a public company. And this needs to be communicated. Now, when the company is delisted, it's delisted, and it is a problem of the new shareholders and the new creditors. Which in remains public, it has to be clear that shareholders that have decided to keep their shares do it knowingly. And it also includes the fact that, the type of deal we do, we create the conditions that allow to optimize the balance sheet. I don't like the word debt push down, although it's very descriptive. But one of the levers we use is, we optimize the balance sheet. We make sure that, resources in dollars are matching uses in dollars or etc. with currencies, maturities. We make sure that the debt is at the level of the entities that can repay the debt, and we obviously are trying to be good managers in terms of the tax bill idea. And this has to be also clearly, described to the market and to the shareholders before they tender their shares or not. After that, yes, we hit some constraints which are, the normal constraints to any shareholder, which is to respect the law and to protect the assets. And we have to be very careful about what we're doing. And I think actually, being under public scrutiny is sometimes less comfortable because you have to use more energy communicating and sharing information, not necessarily at the time when you want to do it, but at the end, it's a good way to check that you're doing the right things. Right. And it doesn't change whether the company is public or not public. That's no difference.
Okay, thanks for all these points. So we've had a very good sort of technical overview of all the technical points relating to take privates. I'd like to move on to a bit of a broader point. Pipes and public equity are very different assets from what LPs expect to have in their private equity portfolios. So maybe this is for you again, Philippe. How would you justify to your LPs having significant parts of your portfolio that are relatively small stakes in publicly listed companies?
First, a remark. I think, altogether facts are stubborn. I think, LPs want performance, and if they receive performance, I think usually they're happy. And on top of it, they understand what we are doing with their money, and we have enough transparency, and they trust what we're doing. So I think there's no right or wrong strategies there. I mean, some firms have explicitly told their LPs they would not do pipes. Others are just saying we can do pipes, and at the end, if you do a pipe which is successful, it's good. If it's not successful, you're going to be blamed for it, and that's business, and it's the same for any business. It's true that some LPs or some investors might not like the fact that they commit money to some private equity firms that will buy stock in the market the way they could do it themselves. But I think the way we seek to do it, or we tend to do it, is always with a view to apply one of the skills we have, which is influencing the management, using our knowledge of different sectors or different industries to help the companies to create value. And it's obviously more difficult to do it when you have a minority investment and when you are in control. But there's plenty of ways when you can do it with a minority investment, and that's what we're trying to do.
Olivier had a point about stub equity that was quite interesting.
Stub equity is a big word that is not very much used in France, but is a structure that has been put in place in the US a number of times, where basically the private equity sponsor actually offers the public to not only cash, but also an exchange offer that allows the public to go up to the investment vehicle, so that at the end of the day, the sponsor actually acquires 100% and manages to take private the target, but recreate the minority stake at its investment holding level. There may be circumstances in which it makes a lot of sense. Obviously, this will help your to optimize your financing structure, to push the debt down, to have the tax integration. So you have all the pluses of a P2P, even though you still have minority shareholders in your holding company. This has not been done in France so far. To a certain extent, it could be done via a mix and match offer, where you would offer minority shareholders either cash or stock of the holding company. It might be an interesting alternative to P2P, given the challenges to succeed with P2Ps.
Okay, we've reached the end of the panel. Please, round of applause for the participants.